Alright, so what's up everybody? I hope you are all doing well. So in today's lesson is actually one of the most important things which you have in forex trading, but people they tend to ignore these things when it comes to what? To forex trading. It's called volume mastery. So imagine this, you may be a trader, not trader, but yeah, about trader, I will start to amboshandisa ma volume. Why? That's the other reason why you are not successful yet in trading, because volume yakaita sei yakakosha. So this lesson is brought to you by me, Zimefes Guru, the one of the CEOs of Royal Blood Forex Institute. So I'm your mentor today. So the hidden edge. So discover the single most underutilized indicator that separates consistent winners from struggling traders. Volume reviews market truth. So what is trading volume, which is the foundation? So trading volume is the total number of shares or contracts traded during specific time period. It represents the total activity and participation in a market at any given time. So volume yakangofanana nekuti tinoziva kuti apa patengwa apa, but hatisi kuziva kuti pasina volume hatizive kuti patengwa zvinhu zvakawanda sei, handitika. So kana takuisa volume into place, patinoziva kuti paplace kwa buy orders yakuchitiudza kuti buy orders acho apinzwa akawanda sei. Tikati apa paplace kwa sell orders nema-smart money, sell orders acho akawanda sei, sehatinoziva isusu market inofollowa volume. Kune volume yakawanda ndokunoita sei, ndokunoenda market. So why volume actually matters when it comes to what? To trading. So it reviews conviction. So high volume equals to strong conviction, low volume equals to weakness or indecision. So let's say for example, I take a breakout and then you see the volume yacho ishoma, likely that breakout is going to be a false breakout. Why? Because tirikuziya isusu kuti volume lenotiratidza chi the number of contracts aiswa ipapo. Ma-smart money kana achipinda market anopinda nemari yakawanda. So tikaona volume iri shoma paitika breakout, it means that breakout yangoiswa mari shoma. They can hide their movement, they can hide pauri kutengera, but they can't hide volume. So confirms price action. So price moves backed by volume are real, price moves without volume are suspects. But price move pasina volume do are likely kuita sei kukurova iwewe, handiti. So identifies reversal. So volume divergence often precise major price reversal. So spot institutional activities. So smart man leaves volume footprints, learn to read them. So smart man pese panenge ichimuva inomuva ma footprints pa market ndo atinoona through what? Through volume, handiti. And then volume reviews psychology. So the heartbeat of the market. So volume is not just a number, it's the emotional impulse, is the emotional pulse of the market. Every spike, every decline, every pattern tells a story about what market participants are actually thinking and feeling. So fear, panic selling creates explosive volume spikes. On downside, fear is loud and visible in volume. So vanhu kana vavhunduka pakaitika fear, volume tinoona ichispika. Why? Because vanhu vari kuita sei, vari kusela vakawanda, people are panicking. Like pakariswa news zeo, you see the volume spiking. Zvikureva kuti pane fear iri market, and then greed. So FOMO, buying creates volume, surges on rallies, greed drives participation and conviction. And then we have uncertainty. So indecision creates low volume and tight ranges. Uncertainty means traders are waiting. So tozoya kuti pane ranging apa, volume is very low. Why? Hapana unakuplace ama trades, hapana ma contracts to measure. So there is no volume in this market. People vaka relax, vanhu vari kuvhunduka, vari uncertain kuti tobaya tosela agatisane nazo. You understand? So the psychology principle, when you learn to read volume, you are learning to read the collective psychology of all market participants. You are reading the market's mind. You understand? So volume as a confirmation, so separating real from fake. So the most critical principle in volume analysis, price moves backed by volume are real, price moves without volume are suspects. This simple rule eliminates 80% of false breakouts. Guys, 80% ukamaster chinhu ichi zvinoita hard kwauri kuti urambe uchipinda mabreakout, because volume hainyepe, havapi vakahaida volume. Volume inotiudza kutoenda market, price iri vachibvekwa nevolume, it means that price is strong because it's backed by what? By volume. zvinoita kuti market inomuvha based on price. You understand? So real breakout, volume stages above average. Kana iri false breakout, volume remains low. So tinomu breakout pachii kana volume yakamira, because patika breakout it means pane vanhu vakawanda vari kuvhura positions. So isusu tikaona volume yakamira, it means mapositions avhurwa haana kuwanda zvekudaro, angovhurwa enough to cause a breakout. So it's a trap. And then price closes beyond level, price quickly reverses. You understand? High conviction participation, weak participation, likely to continue when it's a real breakout, likely to fail if it's a false breakout. So the confirmation rule. So high volume equals to conviction. Strong participation means the move is real and likely to continue, and then low volume means equals to weakness. Lack of participation means the move is likely to reverse. So volume surges equals to validation. A sudden volume spike confirms the breakout is real, because papa kwa positions akawanda nosaka volume ita say yaspayika. The confirmation principle: never trade a breakout without volume confirmation. Volume is a validation that the breakout is real and there is institutional backing. But vazhinji venyu, you have been trading but amuchishandisa volume. You have been trading my breakouts amusingazivi kuti kune chinhu chinonzi volume. That's why you were losing. You understand? So volume divergence patterns. So spot reversal before they actually happen. So divergence occurs when price and volume move in opposite direction. This is one of the most powerful reversal signals in what? In trading. So bearish divergence. So price makes new highs but volume is lower than the previous high. You understand? So what it means is fewer participants are buying at higher prices, buying conviction is weakening, reversal or pullback is likely to imminent. And then bullish divergence. So price makes a new low but volume is higher than the previous low. So what it means more participants are buying at lower prices, selling conviction is weakening, so reversal or bounce is likely to imminent, right? So the divergence principle. So volume divergence is a warning signal. When price and volume disagree, the market is about to make decision. Be ready for it. Number 6, we are going to talk about volume and breakout trading. So we have what you call real breakout versus what you call what? False breakout. So price breaks resistance, volume surges 50 to 100% above average. So sustainable above a breakout level, high probability continuation. And then a false breakout, we have price breaks resistance level, volume remains low average, price quickly reverses back, trap for unsuspecting traders. And then volume based on breakout trading, entry equals only trade breakouts with volume surge above 50%. Information: you need to wait for price to close above resistance on volume, right? Stop just below the breakout level, below resistance. So you need to target, use previous swing high or measured move for profit target. So tataura isusu nezvereal breakout, kataura nezve false breakout. Takuziva kuti if price breaks above resistance level, it's a what? It's a real breakout. Volume surge is 50 to 100% above average. It means that breakout is actually what? Valid, and then sustainable above a what? A breakout level, and then high probability continuation. And then if it's a first breakout, it breaks a resistance level, volume remains low, below average. So the volume remains below average. It means that particular breakout, but this volume is not aligning with a what? With a breakout hechika. So it's likely to be a what? To be a false breakout. And then volume at support and resistance. So the strength indicator. So not all support and resistance levels are created equal. The volume at those key price levels determines their strength. High volume at a level equals to strong support or resistance. A low volume equals to weak level likely to break. So look guys, tataura nezvechinhu chinonzi tinoziva tese kuti masupport nemaresistance, but imi mamusingazivi kuti munoona sei kuti support iri strong or resistance iri strong. Ndakupa a tip kuti tinoshandisa mavolume indicators kuti tione kuti iyi iri strong here kana kuti iri weak. So kana volume yedu ichiratidza kuti iri high volume, price pari kusvika pa support level, volume is increasing, which means more orders are being placed there. That's why the volume is increasing, which means more people are interested in that particular level. and then strong level, high volume at the level, and then if it's a weak level, it's low volume at the level. Strong level, defended multiple times. Weak level, tested once or twice, and then strong level, holds on test. Weak level, breaks on test, and then breakout unlikely on strong level, and then breakout likely on what? On a weak level. So the strength principle, so volume at support or resistance reviews whether the level is defended by institutional buyers or sellers or is vulnerable or being broken. So prediction power, volume at support or resistance is your early warning system for breakout. High volume equals to hold, low volume equals to watch for a breakout. Be careful, kana volume iri shoma. And it then chakuti accumulation versus distribution. So reading the institutional playbook, you're now trading like the 1%, not like the 99%. So accumulation, so smart money buying quietly. So low volume despite price consolidating, price holds above support level. So price yako haisikumove, ikufamba shoma, volume yako iri low. It means smart man are placing their orders, but they are not placing them aggressively. They are buying them. They are placing their orders. They are placing their orders quietly. They are buying quietly, right? So price holds above support level. It's not causing any breakout. It's not moving that well. It's just consolidating. So preparation for a major rally. So volume spike signals a breakout is what is coming, and then distribution. So smart man selling quietly. So low volume despite price consolidation. Price struggles below resistance. Quiet selling by institutions. Doma smart man. Preparation for a major decline. So volume spike signals breakdown coming, so the institutional principle. So smart money moves quietly during accumulation and distribution. When volume finally spike, the move is already decided. Follow the institutional footprints in volume pattern. So you know kana chiziya volume unopinda breakout atatomboitika. You can tell kuti pakunoitika breakout apo atatomboitika. Vanhu panozoda kuzojambira breakout yaitika vanenge vatoraswa kudhara. Iwe unenge watira sei? Unenge watocapitalize. Ndipo vanozoshandisa kuti ZMFS guru ari kuita ma-entries ane ma-zero reason. Why? Because I am reading the footprints. My footprints are always, they are always there. You just need to be smart enough to see them. Those moves are always there. Those entries are always there. And they say, hapana chinoitika pamarket chisingasiwe. My footprints okuti apa panofamba vanhu, apa pane vanga vachibhaya, apa pane vanga vachita sei, vanga vachisela. It's always there. You need to read the market like your playbook. You need to understand. And then advanced volume indicator. We have what you call the OBV. Right? Professional tools for volume analysis with the OBV, the on balance volume. So cumulative indicator that adds volume on up days and subtract on down days. So it shows if volume is flowing into or out of an asset. So it reviews whether volume is supporting or rejecting price moves, and then when to use it when you want to confirm price trends with volume, when you spot divergences early to identify accumulation phases. And then we have another one which I like, which is the what? Which is the VROC, the volume rate of change, right? So it measures the rate at which volume is changing over time. It shows volume acceleration or deceleration relative to recent periods. So it reviews whether volume is increasing or decreasing in strength. So when to use it, when you want to spot volume surges early, confirm breakout strength, identify volume exhaustion, and then we have what you call the MFI, which is short for money flow index. So it combines price and volume to measure buying and selling pressure. It oscillates between 0 to 100, showing overbought and oversold conditions. So it reviews whether money is flowing into or out of an asset. When to use it, when you want to identify overbought or oversold levels, when you want to spot potential reversals, when you want to confirm momentum shifts, and then the pro tip, combine indicators. So professional traders don't rely on one single indicator. Use OBV for trend confirmation, VROC for volume acceleration, and MFI for overbought or oversold conditions. So together they point a completely a picture of volume dynamics. And then now let's talk about a volume based trading strategy, the complete framework for consistent profits. So number one, entry signals. So price breaks resistance, volume surges 50% and above, average, close above the breakout level. We now know kuti breakout. Why? Because the volume yedu iri kuita sei iri kualigna nechi the breakout. So tatova nechi ne first confirmation kuti this is a what? A breakout. Then the second confirmation, price yedu yatovhara iri pamusoro pechi pe that breakout, which means kuti tane a second confirmation. And then takwenda pa number 2, confirmation, volume sustains above average. So price holds above level, no divergence signal. So tana breakout yaitika, but volume yedu ikuramba say yakaholda. And then exit rules. So take profit at target, stop loss below breakout, exit on volume divergence. So risky management. So risky 1 to 2% per trade, percent size accordingly, protect capital first. So entry, confirm, manage, exit. Then you keep your money. So the strategy principle, this volume based framework removes emotion from trading, follow the rules, manage risk, and let volume guide your decisions. Consistency beats perfection over time. So here are the common mistakes that people actually make. Don't make these same mistakes. I'm telling you so that you can avoid these mistakes. Mistake number 1, ignoring volume entirely. Most of you, I know, I'm not saying volume, not ignore. So trading price action without volume confirms results. Ignoring volume entirely, trading price action without volume confirms. Without volume confirmation results in taking false breakouts and whipsaws. So solution, always confirm price moves with what? With volume. No volume, no conviction, which is equal to what? No trade. Because kana tisina a conviction, atina what? Atina a trade. And then mistake number what? Mistake number 2. So misinterpreting volume signals. So confusion volume spikes with volume trends. So a single spike doesn't mean the trend change. So solution, look at volume patterns over time. Compare current volume to 20-day average, not just yesterday. You understand? So mistake number 3, over relying on volume alone. So using volume as the only signal. High volume can occur on false breakouts too. So context matters. So combine volume with price action, support and resistance, and market structure for confirmation. And then mistake number 4, using wrong time frames. So analyzing volume on the wrong time frame. 5-minute volume spikes don't confirm daily breakouts. So solution, you need to match your volume analysis to your trading time frame. Daily trader equals to daily volume analysis. And then mistake number 5, ignoring price action context. So treating volume in isolation from price patterns. A volume without price context is meaningless. So solution, always read volume in context of price levels, trends, and market structure. So bonus, chasing volume spikes. So entering trades after volume spikes is already okay. You are buying after the smart money. So you need to buy before spike raitika. Spike rofana kuitika utori mu trade anditika. So anticipate volume spikes by reading accumulation, distribution patterns, enter before the spike. So the mastery principle, volume mastery, comes from avoiding these mistakes and combining volume with price action, market structure, and proper time frame analysis. Master the fundamental phase and then you trade later. So master volume trading. So the final piece of the puzzle. So volume is the single most underutilized indicator in trading. Master it and you will see the price action with clarity that 99% of traders never achieve. You are ready to join the 1%. So here are the mentorship packages for those of you who are actually serious about making money in trading. Can you feel like I really need to do this? So we have the basic package. Basic package in volume foundation, basic strategies, risk management, and zero miss AI access. And it at $300. And then after you have the elite package, the elite in a $425 in a advanced volume, in a live trading, in a trading guidance, and the full zero miss AI. And then we have the VIP package, which is full mentorship, priority support, private coaching, premium AI access, and VIP signal. So we only take 10 students per month at maximum. So if you want to be part of the 1%, make sure you join this mentorship and be ready to beat the market. So this is just one of the 30 lessons that I teach under my mentorship. So if you actually join this mentorship, you're actually going to make money. I can't guarantee you that after taking my mentorship you're going to win every 20 parts. I can guarantee you this 100% good. Ukatra mentorship young, it's impossible for you to lose because ningo one need the skill. So stay blessed, stay good.